Welcome back to the deep dive. Do you remember where you were for the last quarterly report from Sports Toto?
Oh, man.
Because if you were tuned in for our breakdown of Q1 FY 2026, you probably remember the mood.
Yeah, it was grim.
It wasn't just bad, it was a horror show.
Horror show's definitely the technical term I'd use. I mean, profits had crashed 46%.
Right.
And we spent that whole deep dive analyzing how just this freak stroke of bad luck.
That massive prize payout ratio.
Exactly, the 63.4% payout ratio that basically wiped out their margins entirely. It was this classic case of the house actually losing.
Yeah, paying out 63 cents on every single ringgit earned. And we left that discussion with one really burning question. Was that a statistical blip? A freak accident of probability? Or was it a sign that the house is actually starting to crumble?
Right.
Well, the wait is over. It's Tuesday, February 24th, 2026, and Sports Toto has just dropped their Q2 financial report.
And we have a pretty serious stack of papers to get through today.
We do.
We've got the official filing from Bursa Malaysia, obviously, but we also have fresh analyst reports, hot off the press, from Public Invest, RHB, and TA Securities.
A lot of reading.
Yeah, and the mission today is really simple. Has the luck normalized? And more importantly, with the stock hovering where it is right now, are we looking at a value trap or a hidden dividend gem?
Okay, let's get everyone on the same page before we really crunch the numbers. Just a quick refresher if you're new to this specific ticker. Sports Toto isn't just one business, it's a two-headed beast.
That's probably the best way to visualize it. Head number one is the cash cow, the NFO or number forecast operator business here in Malaysia.
STM lottery.
Right, STM lottery. They sell the tickets people dream of the jackpot. Standard lottery stuff.
Yeah.
Then you have the second head, which is completely different. HR Owen.
The luxury cars.
Exactly. It's a luxury car dealership network in the UK. We're talking Ferraris, Lamborghinis, Rolls-Royces.
Lottery tickets in Kuala Lumpur and Ferraris in London. It always feels like an odd marriage to me.
It is an odd marriage. And as you'll see in this Q2 report, those two heads are currently trying to pull the body in entirely opposite directions.
All right, well, let's jump straight into the headlines then. We need to know if this is a genuine rebound or just a dead cat bounce. What is the big number for Q2?
So the headline net profit for Q2 FY 2026 is RM 45.1 million.
45 million. Okay, give me the context here. Is that a win?
It depends entirely on your vantage point. It's really a tale of two comparisons.
Okay.
If you look quarter on quarter, so comparing this directly to the disaster Q1, it looks like a massive victory. Core earnings jumped over 100%.
Wow, okay, so the bleeding stopped.
Exactly. It means that luck factor we were sweating over is finally normalized.
Thank goodness.
Yeah. The price payout ratio is back to standard levels. They aren't paying out that crazy 63 cents on the ringgit anymore, so the margins in the lottery business snap back.
That's the relief rally right there. The house stopped losing money on the bets. But I sense a but coming.
There is a very big but. When you zoom out and look year on year, so comparing this to Q2 of last year, net profit is actually down 9.2%.
Ouch.
And revenue is basically flat. It's down about 0.3%.
So we're better than the disaster from 3 months ago, but we were shrinking compared to last year.
Precisely. And this is where the analysts are getting twitchy. Despite the recovery from Q1, this result actually missed expectations across the board.
Really?
Yeah. Public Invest points out that the first half of the financial year have only met 31% of their full year forecast.
31% for the half year.
Yeah. RHB is a bit more generous, putting it at 37%. But either way,
They are way behind schedule.
significantly. Public Invest actually had to cut their earnings forecast for the next 3 years by about 9%, purely because of this single report.
Wow.
So while you might feel some relief that the Q1 nightmare is over, the experts are pouring a huge bucket of cold water on the celebration.
Okay, we need to figure out why they're behind schedule then.
Yeah.
Let's strip this down. We'll start with the core engine, the NFO, the lottery business. You said the luck factor normalized, but is the underlying business actually healthy? Are people still out there buying tickets?
Surprisingly, yes. The NFO business in Malaysia showed some real resilience. Revenue for this segment is actually up 3.3% year on year.
That's decent growth for a mature market. What's driving that? Is it just more people feeling lucky?
It's a mix of volume and math. First, the volume side. There was one extra draw this period, so 82 draws versus 81 last year.
Ah, okay.
And in this game, one extra day of selling tickets goes straight to the top line.
Right.
But more importantly, as we touched on, the margins recovered because the prize payout ratio stabilized. When you don't have a freak run of winners, the statistical edge just naturally works in the company's favor.
It's the law of large numbers. Eventually, the house always wins.
Exactly. And speaking of the house winning, the operating profit for the lottery segment actually jumped 30.8%.
That is a very healthy number.
It is. It shows that if you strip away the bad luck from Q1, the machine is still printing money.
Okay, so the core engine is running fine. But we really can't talk about the lottery business without addressing the elephant in the room. We mention this every single deep dive because we have to. The illegal market.
Is the single biggest threat to their economic moat.
Hmm.
RHB explicitly notes in their report today that illegal operators are still rampant.
Yeah.
And the problem is purely access.
Mm-hmm.
The illegal guys just have better digital platforms. They're on your phone. They accept credit, crypto, you name it.
Right.
The regulated market, like Sports Toto, is still fighting with one hand tied behind its back because of strict regulations on online sales.
It's that RM 9 billion figure, the estimated size of the black market. That is massive leakage. But speaking of regulations, there's a really fascinating update in the TA Securities report regarding the political situation in the northern states.
This is crucial. Remember the ban on outlets in Kita and Perlis?
Oh, yeah, where the state governments basically refuse to renew business licenses, forcing legal outlets to shut their doors.
Which just pushes people right to the illegal operators we just mentioned.
Exactly.
While the legal battle is finally moving, management has secured a hearing at the federal court.
The federal court, that's the highest level.
It is. And we have an actual date, May 2026.
That is just a few months away. What are the stakes here exactly?
High. Very high. TA Securities notes that if Sports Toto wins this case, essentially if the court rules that gaming licensing is strictly federal jurisdiction and states can't interfere, they could potentially seek damages for lost revenue.
Wow. So that's not just about reopening shops. That could be a retroactive payday.
Potentially. It's a major future catalyst. If they win, it secures their business model against future political risks across the whole country.
But if they lose?
Well, if they lose, that overhang remains. And other states might get ideas.
So May 2026, mark your calendars. That's going to be a huge month for shareholders. Okay, so the Malaysian business is steady recovering from bad luck, but fighting political and illegal battles. Now let's fly over to London. We need to talk about HR Owen.
This is the villain of the Q2 story.
Yeah.
If the NFO was the hero of the recovery, the motor dealership was the anchor dragging the whole ship down.
I'm looking at the numbers here in the TA Securities report. It lists LBIT. Just to clarify for everyone, that's loss before interest and tax.
That's right. An operating loss.
Yeah.
They lost money just by opening the doors.
It says LBIT expanded by nearly 73% to RM 14.3 million for the first half. That is, that's a lot of money to lose selling Ferraris.
It is a staggering amount, and this is the primary reason for the earnings miss we talked about earlier. Public Invest specifically cites higher motor dealership losses as the main reason they slashed their forecast.
So what is going on over there? Are the British just not buying Bentleys anymore?
It's a perfect storm of three things, really. First, you have the cost of doing business. Both TA Securities and RHB highlight that the UK implemented new labor regulations.
Okay.
So it simply costs more to staff the dealerships now. Inflation has really hit the payroll hard.
Okay, so higher fixed costs right out of the gate.
Yeah. Second is Forex. The exchange rate between the Great Britain pound and the ringgit has been unfavorable.
Right.
When they translate those UK earnings, or in this case losses, back to Malaysia, it looks even worse on the balance sheet.
And the third thing?
Market sentiment. The UK economy is facing global trade uncertainty, tariffs, and just general economic gloom. Even the ultra-rich get cautious in that environment.
Yeah, I guess that makes sense.
TA Securities mentions that this uncertainty is actively discouraging spending on multi-million-dollar supercars.
So we have higher costs to pay the staff, a bad exchange rate, and customers who are just afraid to spend money.
Exactly. And on top of all that, HR Owen has been investing heavily in new showrooms and land. That means depreciation costs are incredibly high. It's what I call a double-edged sword. HR Owen brings in huge revenue, billions in revenue, which makes the company look massive on paper. But right now, it is actively hurting the bottom line. It provides scale, but it's destroying value.
That is a really tough spot. It feels like the lottery business is working so hard to stack cash, and the car business is just burning it in a fireplace in London.
At this specific moment, yes. That's effectively what the financial statements are showing us.
So with missed earnings and a burning fireplace in the UK, you'd expect the stock to be hammered and the dividend to be cut right. Back in our FY2025 deep dive, we talked about dividend cuts being a very real fear, but here comes the plot twist.
The dividend surprise. Despite the earnings miss, the board declared a second interim dividend of 3.0 cents per share.
3 sen. How does that compare to last year?
It's actually higher. In Q2 of last year, they only paid 2.0 sen.
Really?
Yeah, so despite making less profit year on year, they are paying out more cash to you, the shareholder.
That brings the year-to-date total to 5.0 sen. What is the strategy here? Why pay out more when profits are down?
It signals confidence. Management is essentially saying, we know the UK is tough, but our cash flow from the lottery is strong enough to keep rewarding you. It's a signal to investors to just stay put.
And this caused a pretty fascinating split among the analysts, didn't it?
A massive split. This is your classic bull versus bear debate.
Let's hear it.
On one side, you have TA Securities. They look at this dividend and said, we like it. They actually upgraded the stock from hold to buy.
A buy rating. With falling profits and a loss-making UK division.
Their argument is entirely about the yield. They raised their future dividend per share assumption to 10 sen for the full year.
Okay.
They argue that because the company doesn't need to spend much on capital expenditure or CapEx moving forward, they can afford to pay out almost all their earnings. They set a target price of RM 1.59.
So TA Securities thinks this is a dividend haven. They basically buy it for the income.
Exactly. But then you have RHB and Public Invest. They are much more cautious.
I would assume so.
Yeah, they maintained a neutral or hold rating with target prices significantly lower, around RM 1.40 to 1.48.
And what is their counter argument?
They see it as a value trap. They acknowledge the yield is nice, around 7% projected for FY27, but they see no growth.
Right.
They look at the UK drag, they look at the illegal market, and they say, where is the upside? The stock might be safe, but it's not going anywhere.
So it really comes down to what kind of investor you are. If you want a 7% check in the mail every year, TA says buy. If you want the stock price to double, RHB says look elsewhere.
Precisely. It's a defensive yield play versus a growth trap.
That leads us perfectly into our scorecard. We do this every deep dive to keep ourselves honest. Last time, we gave Sports Toto a financial moat score of 6 out of 10. Given the normalized look but the ongoing UK losses, do we change the number?
I've thought about this a lot, actually. We had the recovery in the NFO, which argues for a higher score because the core machine works.
Yeah.
But we have the deterioration in the UK, which argues for a lower score. So I'm keeping the financial moat score at a solid 6 out of 10.
Sticking to the 6, let's justify it for the listener.
The strengths are undeniable. The NFO business is a cash cow. It has a government license, which is the ultimate barrier to entry. You can't just start a lottery company in your garage.
Definitely not.
And the dividend payout of 3 sen proves management is very committed to returning cash, even during tough quarters. The rebound in margins shows the model works when luck is neutral.
And the leaks in the moat. Why not a 7 or 8?
The moat is definitely leaking. The UK anchor HR Owen is actively destroying value right now due to those structural costs we discussed.
Right.
The illegal ocean, that RM 9 billion black market, hasn't gone away at all. And the regulatory risk in Kita and Perlis is a huge overhang until at least May 2026.
So 6 out of 10 seems fair. It's a profitable licensed monopoly that is carrying a very heavy backpack called HR Owen.
That's a very visual way to put it.
Yeah.
And until they fix the UK operations or win the battle against the illegal market, they just can't climb higher than a 6. The recovery from Q1 prevents a downgrade, but the missed earnings prevent an upgrade.
Makes total sense. So what does this all mean for you listening right now? Let's wrap this up with a verdict.
If we summarize Q2, call it a stabilizer. The bleeding from the Q1 look factor stopped. The patient is no longer in critical condition. But a new wound has opened up in the UK car business that needs stitches fast.
So if I'm already holding the stock,
If you're an existing shareholder, that 3 sen dividend is a keep holding signal. The yield is safe for now, and you're getting paid to wait for the turnaround.
and for new investors looking at this fresh today,
It depends entirely on your appetite. If you want a boring, high-dividend stock, and you believe the UK economy will eventually turn around, this is becoming attractive. That's the TA Securities buy case.
right?
But if you are looking for growth, or if you are worried about the ringgit or the British economy, there are probably better places for your money. That's the RHB neutral view.
Now here's a thought to leave you with. We always talk about gambling when we talk about the stock. Usually we mean the lottery players buying the tickets. But looking at this legal battle,
Right.
we know the lottery business relies on probability. But right now, Sports Toto seems to be gambling on a turnaround in the British economy to save their margins.
Yeah, they really are.
And with that federal court date set for May 2026 regarding the state licenses, the real question is, are you betting on the numbers or are you betting on the judges?
And that is the multi-million ringgit question. The legal outcome in May could swing the sentiment on this stock more than any jackpot result ever could.
Absolutely. Well, we want to take a moment to sincerely thank you for following us on this multi-quarter journey. We've tracked Sports Toto from the highs down to the Q1 horror show, and now this stabilization. It's been a wild ride.
It really has. We appreciate you trusting us to break down these dense reports. It helps us stay sharp, too.
It does. If you enjoyed this update, please smash that like button. It really helps the show. Subscribe so you don't miss the Q3 update, because we really need to see if that UK bleeding stops.
For sure.
And leave a comment below. Do you think the 7% yield is worth the risk of the UK car business? Or is H.R. Owen just too much baggage?
I'd love to hear your take on the buy versus neutral debate.
Let us know. Until next time, keep analyzing.
And trade smart.